In this tutorial, I'll be going through with JJSF symbol. I'll just copy that and paste that in Google and write stock beside it. And you can see the name. And the information on the left hand side is from Google, and on the right hand side is from Wikipedia. If I want to buy the stock right now, I have to pay 163 US dollars, which is the currency. And it is founded in 1971. But if it's not written outside, you can simply click on Wikipedia and you can see a box inside, and you can see founded in 1971. And I'll show you some important ratios. The website I use is Macrotrend. I've left the link in the description, but you can just let me know if you have any questions regarding it or anything. I'll be happy to reply. Just leave any questions below the comments. And just paste in the symbol and make sure that the name matches the symbol, and click on price ratios and price book ratio, and it's just loading, and I'll let you know. Okay, so book value is the real value of the stock, it's the real worth, and stock price is the market price. So if the stock price is $2 and the book value is $1, that means somebody is paying $2 to buy something that is $1, which is expensive. So we want to know price to book ratio. We want to know if it's less than 1, that means the stock is very cheap, it's undervalued, and it's at a bargain. So we should must buy that. It's ideal. And if it's 1, that means that the stock is not expensive or cheap, so it's the right price, which is good as well. So at least we're not buying something that is expensive, it's for the right price. If it's more than 1, that means the stock is very expensive. And the higher the number goes, the more expensive it gets. Right now, it's 3.93, which means that somebody who buys the stock right now will be paying 3.93 times more money. So it's nearly 4 times more expensive to buy the stock. But it was cheapest in 2008 when it was 1.48, nearly 1.5 times more expensive. So somebody who bought that time, they also bought an expensive stock because it was 1.5 times more expensive. But right now it's 3.93, which is 4 times more expensive. So you need to be careful about that. Let's look at other ratio. I'm interested in current ratio. Current ratio tells us if the assets are more than liabilities. So if the ratio is less than 1, that means the stock is very risky because the liabilities are more than assets. If it's 1, that means that assets equal liabilities, which is good. But what we are looking at is when investing in a stock, we want margin of safety. We want the stock to be secure and not risky. So we are looking at 1.5 or more than that current ratio, ideally. So let's look at the current ratio. Okay, so the current ratio is 3.63, which is way above 1.5, which is very good. It means the stock is very safe. Let's look at consistency. So I just want to know that if it has ever been below 1.5, and no. So we have data since 2005 up till now. up till March 2019. So it's nearly 14 years consistently it has been above 1.5, which is brilliant because that means it has been consistently a safe and secure stock. Let's look at debt equity ratio. Debt equity ratio tells us if the company is mainly operating on debt or equity. We are looking at ratio zero point 0.5 or less than that. Right now it's 0, which is brilliant. And let's look at the previous one. So it has been consistently 0, which means that it has been consistently 0, which means that it's doing really good. Um, Return on equity should be 8% or more than that for it to be brilliant. Let's look at the return on equity. So this is the return the shareholders are getting because what they have invested. So let's look at the equity return. Okay, so we are looking at 8% or more than that. Right now it's 11%, which is more than 8%. Let's look previously consistently. Let's look if it has ever been below 8%. Never. So it has never been below 8% in 14 years, past 14 years. So which is brilliant. It's doing brilliant in terms of return on equity. Let's look if this firm pays any dividend. It does pay dividend of 1.22%. Dividend means that if some firm pays dividend, that means that after paying their creditors, after paying their cost of operation, after paying their loans or liabilities or whatever, they still have extra money left. So that extra money is called dividend. So they pay it to their shareholders. Even if the percentage is not very big, it's a very small percentage, but still that's the extra money left. So they are financially doing good. It reflects that they are financially doing good, that they are paying the dividends, which is brilliant. Now let's look at I will just copy that and I want to see what the employees have to say. So I'm gonna check that in Indeed, which is a brilliant website, and you can see 68 reviews and it's 3.6 stars, which is above average. So this is good in link in Indeed. And let's now look at in Glassdoor because that's another brilliant website. So we have total 31 reviews, which is not a lot, but still it's 3 star, which is good. It's average. And I want to see what the finance key executives are, and what are their salaries. So I'm just interested in that as well. So I'll go to profile, and I'll see the sector is consumer defensive, industry is packaged foods, and 4,500 employees are there. And so we have key executives, and all of their salaries have been shown, which is brilliant because the more transparency, the more information a company provides, the better trust we can have. So all the salaries have been shown. Now let's look at Justia Patents, which is a patent firm, and I'll just paste here and I'll just search it. And I just want to show that I'm not interested in inventors because those are people who invented but they don't have full rights. I'm only looking at assignee or applicants. So let me see. I'm just gonna take the exact name from here because sometimes it doesn't appear like that. So from Google I'll take exact name, and let's see if it has any patents. Yes, this one, that's the signee. What we're looking at, that's the exact name. So in 1995, it has patents, then 1996, and that's it. We only have 2 patents, and these patents are like very old, more than 20 years. So, which is good that when they they have patents, but I'm more concerned that why don't they have recent patents? Because it's like more than 20 years ago they have patents. Patents act as a moat and competitive edge, but why they don't have any patents, like that's something to think about. Why they don't have recent patents, because that means that they're still thriving, they're still being competitive. Patents act as a moat, but the patents that they have are only 2, and they're very old. So that's the point. Um, and what else I want to have a look. So I want to see if it's a million company or a billion company. I'll just type that in Google, and I can see the market cap is in billion, which means it's a very big company, which is brilliant. And what else I need to show you?